Hello, beautiful people. How are you? I hope you are doing fine wherever you are. I welcome you all to this important lecture towards our examination, that is life cycle costing. This is part of our revision. We have so far covered a lot of topics, and life cycle costing belongs to that category of the syllabus, which is normally called specialist costing techniques. Its peers include activity-based costing, target costing, throughput, accounting, and then environmental management accounting. All right, so it belongs to these guys, and it is sometimes a troublesome area in section A questions. So by the end of the theoretical aspects of this topic, we are going to look at about 7 past exam questions related to life cycle costing. So please hang on, stick around as we progress with the video. Now, what is life cycle costing? This one is a costing technique that tracks and accumulates costs and revenues attributable to each product over its entire product life cycle. So we are not looking at the single phase alone, but the whole phase from the start to the decline phase of the product. When we are saying start, we are referring to those costs which are incurred even at the research and development level. So what is included in life cycle costs? Life cycle costs include research and development costs, production costs themselves, the cost of producing the product, sales and marketing costs. Those are also included in the cost of the product. Those costs which we are going to incur to ensure that the product is made known in the market. Okay, those costs when we are making our customers aware that there is a certain product in existence. Then any other costs are incurred during the product's life cycle. So here we are looking at those other costs, for example, administrative costs or the costs towards the end of the life of the product, end of life costs or decommissioning costs. Okay, decommissioning costs, they are also included in the cost of the product. Now, let's look at the product life cycle stages. Right, so we have got 5 stages. That is stage number 1, stage number 2, stage number 3, stage 4, stage 5. Now, in stage number 1, this is the pre-production stage. Pre-production stage, where we much of the costs will be on R&D, research and development of the product. So you can see that at this level, remember this is our the level of income we get from the product. So they are largely negative incomes or cash outflows. Why? Because we'll be only investing in research and development of the product. No market introduction has been done at this stage. Right, then we move on to stage number 2. Stage number 2 is about market development and launch phase. The launch phase here, we are introducing the product to the market, and the marketing team has to be hard on the ground to ensure that we get our product known to the public. Yeah, that's the idea. We are introducing the product to the market. We are incurring heavy costs on marketing. So at this level, our sales are gradually rising, right? But in terms of profitability, we are still in the negative. All right, but by the end of the phase of the marketing phase, we are at least reaching some break-even point. Okay, we are not sustaining negative profitability or positive. We are somewhere break even. So our sales are adequate to meet the break-even point towards the end of that phase. Then after that phase, we start to incur some profitability. Yeah, our profitability line is growing, which means this becomes the growth phase. The product has gained much attention in the market. It is now being known and sales are increasing rapidly. Then on maturity, we have actually sustained the market. We are known. It has become some cash cow of some sort. The product has, mature, has become mature enough to be known as an industry leader, something like that, or market leader. All right. And as you can see, towards the end of phase 4, the product starts to decline. It has reached its maturity. And then in terms of profitability, we are seeing that the profit starts to, decline as well as the sales. All right. So at this stage, we expect to have its replacement in place. The company would have invested in some other replacement product. And by the decline phase now, here, the sales and the profitability has radically declined, which means we are about to phase out the product. We are about to phase it out. All right. So, in essence, that's the product life cycle in picture. Remember, at this stage number 5, we have got what are called end of life costs. End of life costs, like decommissioning costs, they are also incurred at this particular stage. So how can we ensure that we maximize product return over its life cycle? There are about 4 ways of doing that to ensure that we enjoy the best of the product to its fullest, like the maximum benefit from the product. So we can do that first of all through designing costs out. If we are designing costs out, for example, 90% cost commitment at design stage, we need to ensure that our design will be in such a way that we are going to have some maximum return on the product. Poor designs tend to give the company less profitability. So we need to ensure that our design costs are, the cost at the design stage should be kept minimal. So most costs are determined at the design and development stage. Use cross-functional teams, not isolated designers, to ensure that, when we have got some diverse input from different departments toward the product, we are going to get more information on how to design the product to, with regards to cost effectiveness. We need to apply value engineering to reduce components, simplify production, and maintain customer value. Value engineering is all about knowing what is really important to the customer. How are customers going to perceive value towards our product? So we can see that in value engineering, there is an aspect of mass production, but with value enshrined. We have to ensure that the product can be produced through mass production, but at the same time, maintaining customer value or maintaining the value the customers would want. For example, in car production, you would see that even the most expensive Mercedes-Benz is being produced through mass production. We ensure that there is consistency in production. There's also the aspect of value retention. All right, we can produce more, but while it's maintaining the value required. Okay, that's value engineering. Also, the aspect of simplified production. We need to ensure that we cut costs as far as possible to ensure that at design stage, the cost of production is minimized. Then we need to minimize time to market. If we take longer to bring the product to the market, we will be incurring costs to the company. So we need to launch it faster, all right? Because longer profitable market, this will lead to longer profitable market presence. Some products, for example, certain technologies would not stay longer in the market. So the quicker you launch them, the better, because after a certain time period, they will be phased out. So if you delay, if you delay trying to perfect it, extra perfecting it, all those things are going to impact negatively on your profitability, because the product by nature is not going to be longer on the market. To take a longer time on the market. So delays reduce profitability more than cost overruns. Early entry helps establish brand before competitors react. So we need to run to ensure that we introduce the product as early as possible. Minimize break-even point. So we need to ensure that the break-even point is achieved as quickly as possible through smart pricing. Remember, when you talk of pricing, usually two things should come into your mind in whatever situation: the aspect of penetration pricing, or price scheming, or premium positioning. All right, so we might decide to charge a lower price so that we push volumes, but at the same time attracting a lower contribution per unit. So this one is price penetration, isn't it? Or penetration pricing. They say market penetration or penetration pricing, something like that. All right. And then high price. This one will give us some high contribution, but possibly pushing low volumes. We need to decide which one is the perfect thing to do. So this one is to do with skimming, price skimming. Okay. Now, the fourth one, maximize product lifecycle length. So in maximizing the length of the product's lifecycle, we might ensure that we get much of the benefits of having that product for a long time. So we need to launch early. So the aspect of launching early cannot be overemphasized to extend profitable period. We need to find new uses or new markets. So the marketing team should be thriving to ensure that we obtain new markets. If we were supplying only to the urban people, we need also to consider the rural folks. At the same time, we need to also advertise on other areas the product could be used, not only maybe for domestic, dishwashing. Sometimes the item could also be used for industrial purposes. Use staggered global launches to increase revenue and extend the life. This one, again, we should also consider going global, not only to, supply our local markets. We need to consider skimming to maximize lifetime returns. So skimming, like I said, is very, very useful, especially when we are having a product and we are the first company to launch it. We can capitalize on charging high selling prices initially to ensure that we we recoup whatever revenue that can be obtained, because we are still the sole suppliers of this particular product. So we can capitalize in charging higher prices initially before competitors join, so that when they join, we can be able again to maintain the market or to retain the market share through price reduction at the later stages of the product life cycle. So skimming is actually going to be the way to go. Now let's look at this formula, which we are going to use in most of the computations involved. So life cycle cost of a product. Life cycle cost of a product. Do I have a pen here? The life cycle cost of a product A is equal to the total cost of product A over its entire life cycle. The total cost. Bear with me here. bear this in mind. Total costs. We're not looking at just costs in a particular year or costs of a certain type, but all the costs involved in making or manufacturing this particular product. Remember, we are also looking at those costs which were incurred before the product was launched. For example, the research and development costs, they're also part of this product. Even after the product has been phased out, they are what are called end-of-life costs. They are also going to be considered. So all the costs of the product over its entire life cycle divided by the total number of units produced or total number of units of the product. So this is how we determine the life cycle cost of a product. And after we determine the life cycle of the product, then total profitability of any given product can be determined. Unless we know the total cost, the total life cycle cost, we are not going to be able to determine the profitability of that product. That is at least in the life cycle costing science. All right, why do we need life cycle costing? Sometimes management would want to know the overall profitability of the product over its lifespan, not only the annual product profitability assessment, but would want to know in advance how this product's costs will amount to. Then we then have to be in a position to, forecast its profitability. All right. So the overall profitability objective will be at play here throughout the product's lifespan. Then when R&D costs are high, which would distort profitability analysis in initial years, lifecycle costing becomes instrumental as it spreads those costs over the product's life. Sometimes it doesn't make sense to, let's say, the product is still at stage 1. Okay. So at stage 1, we know that in terms of the graph, we are having profitability, which is still in the negative. Okay. So it makes no sense to assess of the profitability of the product in stage 1 or simply piling the cost in stage 1 alone. Why? Because at stage 1, there is no market introduction of the product, so we cannot expect any profitability. So that information is not going to help managers. But what is going to assist managers is the overall assessment throughout the life cycle of the product. And then this is why we have to spread these costs. Right? They have to be spread throughout the product's lifetime or life cycle, so that a meaningful analysis is going to happen. So here are the benefits of life cycle costing. Number 1, by determining the selling price on applying markup on life cycle cost, the firm is assured of profit during the product's life, right? So, like I said, because we now know the entire life cycle cost of the product. Let's say the cost per unit is $10. We can now safely determine the appropriate selling price for that particular product, knowing that we are guaranteed that we will be having some profitability. So it gives us, some clearer picture of what the actual cost of the product or the true cost of the product is, but including end-of-life costs such as decommissioning costs, site restoration cost. Lifecycle costing helps the firm to internalize environmental costs. So it actually, you see, the principle of LCC, the lifecycle costing, ensures that companies are put to task to ensure that they take the responsibility of environmental costs through serious commitments. So they take the responsibility seriously. It's no longer an issue of maybe seeing them as something else, but it is now part of their corporate strategy. If they are using lifecycle costing, it actually means that they are bringing the idea into the serious tenets of the business strategy. Then lifecycle costing can therefore safely be said to be meeting the requirement of environmental management accounting. So in short, the above important, the above point, this point is actually made important by the fact that when we are having lifecycle costing in our midst, we are therefore meeting the requirements for environmental management accounting or the principles enshrined thereon. Okay, now the honeymoon is over. Let us dive into typical exam questions. So lifecycle costing is going to be tested, guys. It's part of the syllabus, so we need to be very, very aware and alert about this troublesome area. It's not troublesome as such, but it might cause some unnecessary headaches. So a manufacturing company which produces a range of products has developed a budget for the life cycle of a new product P. The following information, the information in the following table relates exclusively to product P. So we have got the lifetime total and the cost per unit. So design costs, we are given a total. Direct manufacturing costs, we are given the cost per unit. Depreciation costs, we are having 500,000. Decommissioning costs, 20,000. Machine hours, we are given the hours per unit. Then production and sales units, 300,000. The company's total fixed production overheads are budgeted to be 72 million each year, and total machine hours are budgeted to be 96 million hours. So when I see budgeted costs and budgeted activity, something comes into my mind called the overhead absorption rate, the OAR, which is budgeted cost over budgeted activity. And in this case, that's 72 million divided by 96 million hours. That's the activity. So you get your overhead absorption rate there, which could be used when you are now determining the life cycle cost per unit. And if you use your calculator, the overhead absorption rate there should actually be 72 over 96. That's 0.760, $0.76. Okay, so in overhead, or let me just a fixed production overhead, all right, is because we are told that they are being absorbed on machine hour basis, so it's costing 76 cents per hour. So your duty now would be to determine how many hours are actually used, which is a product of 300 multiplied by 4, because 300 is the 300,000 units which are going to be produced, multiplied by 4 hours. Then you get the total number of hours which you are going to then multiply by the overhead absorption rate. So in this case, that's 300,000 multiplied by 4, that's 1.2 million, isn't it? So multiplied by 1.2 million. And we can safely use our calculator again. So that's that amount multiplied by 1.2 million. That's 912,500. Okay, so we get that. So we can then safely say, let us now list all the costs in this question. Okay, so we just have to follow the way the examiner is presented his information so that we won't miss anything. So we start with the design costs. These ones are given in total, so just have to slot in the figure as it is. Then manufacturing costs, direct man costs. These ones are given as $20 per unit, so we need to multiply by the total number of units, that is 300,000. These are the total units produced. So this gives us how much? 300 by 20. Already that's a big number, isn't it? Here's my calculator. That's 20 multiplied by 300,000. So that's 6 million. depreciation. Depreciation, ladies and gentlemen, is part of the administrative costs, so it is included for life cycle costing purposes. Do not tell yourself that in relevant costing you don't use depreciation and this and that. Hello, in life cycle costing you need to include it. So that's 500,000. End of life costs, the decommissioning costs, decommissioning costs. These ones are given in total, so we just have to pick the figures it is. Then machine hours are related to the overhead absorption rate, so they have to be included as production overheads. And we did the computation and we determined that it was 912,500. So let us get the total. So where is our calculator? So that's 800,000 plus 6 million plus 500,000 plus 20,000 plus 112,000. 112,500. So that's 82325. 8232500. All right. So this is the total life cycle costs. But now we need to get the cost per unit, because the question is saying what is the budgeted life cycle cost per unit. So we'll take that one and take this amount, 8232500 divided by 300,000. So we come here and say answer divided by 300,000. So we get 27.44. And then the number that is, the cost per unit that is nearer to 27.44 is actually 27.40. So the difference is due to rounding. Okay, it's due to rounding. Remember, there was some rounding which we took, which was considered there. So that's our answer on that part. You can do this in Excel and you will discover that it becomes faster. All right, let's proceed. A company has produced the following information for a product it is about to launch. The product is expected to have a life of 3 years, right? So year 1, year 2, year 3. Expected sales 2,000, 5,000, 7,000. Variable production cost per unit $2.30, $8, $20. Fixed production costs. So usually the entries that require adjustments are those ones which are saying per unit. These ones per unit, which means then you have to multiply these by the total number of units, respectively, by the units produced in those particular years, and then you get the total. And then the costs here, they are given in total, so you just have to pick those figures and get the appropriate answer. So let us do this one in Excel to see if we are mastering the game. All right, so I guess you guys are seeing this thing. Okay, let me try to get I need some Excel page somewhere. So if I don't get that, am I going to be happy? So the Excel, but I now need the question. So what's going on? That's the question on the screen, guys, and I guess we are seeing it properly. I'm yet convinced, but okay. So this is question 2, right? Question 2. Life cycle cost per unit. In the exam, no need to type this, right? No need to type this if it is an objective test question, because the Excel is not going to to be marked for that particular section. So you just have to do what is required for you to get the answer and move on with your life. All right, so let's start with the variable costs. Okay, the variable costs. Remember, we need these costs in total. First of all, determine the total costs. That's the trick, guys. That's the trick. Okay, you can put your $sign there. So here it's equal sign. The costs per unit in year one was $2.30. You then have to multiply that by the total number of units produced in year one, that is 2,000. Okay, you can close bracket, then you add plus for year two, that's $80. The cost per unit multiplied by the number produced, that is 5,000, right? I'm forgetting brackets, I'm sorry for that. Then you say plus, open bracket, $20 multiplied by 7,000, close bracket, press enter. So you can see that for the variable costs are 22,000. We move on to the second item there, that is fixed production costs, fixed costs. The fixed costs, you say equal sign. These ones were given in total, so you just have to pick these numbers and add them across. So that's 3,000, equal sign 3,000 plus 3,500 plus 4,000. That's 10,500. We move on to the variable selling costs. Variable selling costs. These ones were given per unit, so we need the totals. The totals, so that's equal sign, open brackets. If in year one, that's 50 cents, that's 0.5 multiplied by 2,000, which was the total number of units produced in that year, plus open bracket 40 cents, 0.4 multiplied by 5,000 units, plus open bracket 40 cents multiplied by 7,000 units, close bracket, get our total. Fixed selling costs, fixed selling costs. These ones are in total, so that's 1,500, 1,500 plus 1,600 plus 1,600 again, press enter. Then lastly, admin costs. These ones were again in total, so that's equal sign 700 times, so that's 700 times 3. You can simply say 700 multiplied by 3, and you get your 2,100. Then you get your total life cycle cost. So that sum get 45,000. So that was very quick, isn't it? And then units. We know that the units produced were equal sign 2,000 plus 5,000 plus 7,000. So that's 14,000. So the life cycle cost per unit becomes equal sign that divided by that, $3.22. So this is our life cycle cost per unit. We can see that our answer then becomes C. Here I'm not seeing my drawing, but C is our answer there. You can safely, that I'm not getting the drawing console. All right, so that's the idea behind life cycle costing. That's our answer, ladies and gentlemen. Okay, now we are moving on to another question here, which has once again been adopted from the Kaplan revision kit. This is question CNT. CNT is a Japanese electronics giant specializing in the production of game consoles. So their product is the game console. That's what they supply. SNT is planning to introduce the latest next generation console and range of games in the summer of 2020. Development of the new console is due to commence on January 1st, 2020, and SNT is currently working out at what price the new console should be sold then. The new console is expected to incur the following costs in the 4 years it will be developed and commercialized. So, from development to commercialization. Consoles manufactured and sold. So these are the units. That's the units manufactured and sold. They're the units. R&D costs right? So here, this is now the cost information. The costs R&D 950,000, and it is occurring in the first year. I mean, in the pre-launch phase, that is 20x0, right? So we only have got, this is the stage where the initial stage of the production or of the item, all right, that is 20x0. That's when we are going to do the research and development of the product, right? And then from this, we are going to have about 10,000 which are manufactured in that particular year, and then we move on to other years. We are also going to incur the marketing costs, production cost per console. So these ones are total. Yes, are in total. These ones is in total. Production cost per console. This one now are per unit. So if it is per unit, you need to multiply by the total number of units produced. This one is also per unit. Okay, and the last one is total. So what do we have to do? We then have to come up with that tabulation again. So let's go to Excel, ladies and gentlemen. Why? Okay. I'm sure you're seeing the question clearly. All right. So this is question number 3. So number 3, SNT. All right. So we can have our dollar sign as usual here. So we start with the R&D costs. R&D, with just 950,000 in year 0. Then marketing costs. These ones were in total again. That's cosine 230, 130,000 plus 120,000 plus 20,000 plus 5,000. That's 375,000. We move on to production costs per console. So production costs in total. Now we are given per console, so we just have to do what we did earlier on. That's 450, which was the cost. The cost per console multiplied by the total number of consoles produced. That is 10,000 in year 1 plus open bracket 430 multiplied by 12,000 units produced in that year plus open bracket 290 per console multiplied by the unit total number of units produced 11,100 plus open bracket 290 multiplied by 3,000 units. Press enter. It was quite a large figure. Anyway, that's it. It is what it is. Warranty costs in total equals sign open brackets. This one was $30 multiplied by the total number of units produced, that is 10,000, close bracket plus open bracket 30 again multiplied by 12,000, close bracket plus open bracket $40 multiplied by 11,100, close bracket plus open bracket 45 multiplied by 3,000, close bracket, and then end of life cost. This is equal to 125,000. It's just a single figure. Press enter there. You get the total lifetime costs. Total lifetime costs equal sign sum. That's the total. Then you have to say units produced equal sign 10,000 plus 12,000 plus 11,100 plus 3,000. LCC per unit therefore becomes equal sign this divided by that. So this is our lifetime. And what's going on? This thing is ticking. So that was our lifetime cost per unit. But now we need to get back to the question, because we need to hear what the examiner wants from us. So let's complete the question. Market research has indicated that consumers will be prepared to pay an average price of $420 per console. So there is a problem. Our life cycle cost has been 445, which is larger than what the customers expect to pay as a selling price. So we've incurred much production costs. But since Chief Executive believes this will not be sufficient to make production worthwhile, yes, because if the selling price which is offered is actually lower than the cost price of production, then we are in trouble. It won't be worthwhile to produce or to continue with the production. So which of the following statements made by the Chief Executive are true regarding the cost of the console? So we have got this in mind so we can have the best of slideshow here, because currently we need to discuss this thing in detail. So we know that the cost of production was $455 according to our computation. So what do we do, guys? We need to then look at these two statements. These two statements have to be analyzed. The first statement is saying the cost per console calculated using lifecycle costing principles is higher than the price customers are prepared to pay. Yes, 455 is higher, so this one is actually true. But the question wants us to determine which statement is true regarding the cost of the console. So the first one is telling us that the cost per console calculated using lifecycle costing principles is higher than the price consumers are prepared to pay. What about the second one? More attention to R&D costs in 20X0 could reduce warranty costs in later years. I see this statement as true. Yeah, if we remember when we talked about maximizing the return on the product's life cycle, we determined that if we design out costs, we are likely to incur some reduction in future cost. But now, by designing out, it doesn't mean that we are going to use materials which are of poor quality. No, we are simply saying that our designs should limit our exposure to costs, but at the same time maintaining the value to the client, or maintaining the durability of the product. So if we do our engineering properly, we are going to ensure that warranty costs. Remember, warranty costs have to do with good returns. So we don't want a situation where items are going to be retained for repair, we incur repairing costs and so forth. Because the moment we give warrant rights to customers, it means that when those products become faulty, the customers will have the right to return them to us so that we repair them, we rectify the anomaly, we give them within a certain time period. So if our design is addressed properly, if we give attention to our design, we are likely to reduce such costs because our products won't be returned for repair. Is that clear? So, in as much as we are saying designing out is much related to cost reduction in a general sense, we are simply saying the designing of the product should also be linked to its durability. We need to design carefully to ensure that errors are minimized in the product, faults are minimized. So this one was true. So what is the answer? The answer is both 1 and 2 are correct. Now, let's talk about this drag and drop style question. Yeah, remember we are using the PowerPoint slide, so it's impossible to have that type of question in its live state. So we just want to discuss what was involved. Okay, a drag and drop style question is that one where you simply have to drag the possible answer and slot it in the required answer portion. All right. Like for example, you can drag if if this one is your answer, you simply have to drag it and drop it in the appropriate answering box, something like that. Okay, or you might be given a series of boxes where you need to drag it and drop into those boxes. All right, so let us look at this particular problem. Which four of the following are said to be benefits of life cycle costing? Number one, it provides the true financial cost of a product. Yes, this one is one of the correct options, because in life cycle costing, we want every detail of the cost of the product from the initial stage to the last stage. All right, from research and development to the product is phased out, or to the decommissioning or end of life cost. Everything will be considered. So it gives some more assurance on the financial cost of the product. The length of the life cycle can be shortened. The idea of life cycle costing isn't really about to reduce the cost of the life cycle of the product. Why? Because the larger the life cycle, the better in terms of maximum utility, in terms of gaining more return on the product. We would want it to have more shelf life. That would be our prayer, because the more the life, the higher the return. Although in modern day business, these products tend to have a shortened life cycle, but the idea will be to gain as much as possible on a longer shelf life of the product. Okay, so this one is not. Expensive errors can be avoided, in that potentially failing products can be avoided. Yes, we can, because of life cycle costing, we can remember, we can design out certain things, we can improve designs and so forth. So we can, if there is no other way to ensure that the design can be adjusted, then we can still avoid the whole thing. So life cycle costing gives us much more clearer lenses to see what is going to happen to this particular product given these scenarios. So this one is correct. Lower costs can be achieved earlier by designing out costs. Yes, we can ensure that our designs are so cost effective, right? So that one is a correct option. Better selling prices can be set. I can give a question mark on that. Decline stages of the life cycle can be avoided. This one is simple. All right, this one can be a simple option. I can at least go for. This one is saying that we can, avoid the decline stages. Is that possible, guys? You cannot avoid decline stages of the life cycle of the product just by using life cycle costing. No, you cannot avoid it. All right, that one is a lie. It's not correct, because the decline is usually independent of us. It is something that is determined by the market. If the market feels that a certain product is no longer worth of purchasing, then the decline stages, the decline stage inevitably comes by. So we have no control over the decline stage from using the life cycle costing. We're not going to enjoy the determination or extension of the decline stage. So this one is incorrect. Then let us come back to better selling prices. I feel life cycle costing gives us more clearer lenses on the behavior of the product. And now that we have got the cost information, the true cost information, we are in a better position to set a price that is competitive, but at the same time giving us some profitability. So we are having more information. so we can set better selling prices, which are going to ensure that we are competitive, but at the same time we are profitable. So this one is also a correct option. So how many correct options we have? We have this one. Okay, this one was a correct option. This one again. This one. This one. Wow. So guys, it's very easy, right? You just have to use your brains, right, as you'll be answering these questions. Which of the following statements are true regarding the justification of the use of life cycle costing? Justification is simply the reason why you can say let us adopt life cycle costing. Number one, product life cycles are becoming increasingly short, not by our design, but in general, product life cycles are becoming increasingly short. Remember, in manufacturing, there is what is called planned obsolescence. Planned obsolescence simply means manufacturers tend to produce things they know customers, even if they are very careful, they're not going to enjoy those things for a longer period of time. For example, bulbs, electric bulbs in our homes, they are designed in such a way that when they reach a certain amount of hours, they are going to blow out, even if you are very, very careful. All right. So, I mean, that's the idea in the area of commerce. Somebody once wrote an article about a certain bulb in Washington, D.C., in the Americas that was created. It was that bulb is in the public space. It was created around 1940. Yeah, it was manufactured then in around 1940s, but it is still on to this day. It has never gone out. It has never been, put off. It is still on by this day. So in those years, products were being manufactured with the idea of being there for a longer time. But now, these days, the products are becoming, their life cycles are becoming increasingly short, right? So this means that the initial costs are an increasingly important component in the product's overall cost. So this is why we want life cycle costing, because it gives us the information on the product's initial cost, which would be spread throughout the life of the product. So when we are setting a price, that price should factor in those costs which we initially incurred. If we do not consider life cycle costing, it means that those initial costs which we suffered might be ignored by management, and managers will tend to, to be shocked when we are running into, losses. Why? Because there were certain costs which we incurred earlier on, but were ignored. We only factored in areas where those costs were incurred, but not in the later years when the product was now expected to bring some revenue. So we need to factor in those earlier costs in our selling price to ensure that we remain competitive, but at the same time profitable. So the first one here is important, but remember, we are not saying life cycle costing is going to be important just because it will enable us to shorten the product life cycle, as in the previous question. We said this one was wrong because life cycle costing itself does not make products life cycles to be short, right? So this is why this one was wrong. But this statement is simply saying that it is generally understood that these days product life cycles are now shorter. So it is important to factor in the earlier cost of the product so that they can be spread throughout the life of the product. Is that clear? Good. Product costs are increasingly weighted to the start of the product's life cycle. And to properly understand the profitability of the product, this cost must be matched to the ultimate revenue. So this one is still giving emphasis to the idea of spreading costs. Okay, so it's correct. Then The higher cost, for example, research, design, and marketing in early stages in a product lifecycle necessitate a higher initial uh, selling price. While it makes sense, it doesn't necessarily mean that we are always going to charge a higher initial selling price. Sometimes, remember, I gave you the two smart options. Sometimes there's no need for you to charge a higher selling price because you might discover that when you charge a higher selling price, competitors might be there. It doesn't mean that all the products we are going to introduce do not have competitors at play. Sometimes we will be the second competitors or third competitors of a certain product market. So in that situation, if you are not the first person to be in the market, please consider penetration, consider market penetration or penetration pricing, which means you need to charge a lower price for you to push volumes. So this one, because of that argument, this one is wrong. 4. Traditional capital budgeting techniques do not attempt to minimize the cost of maximize the revenues over the product lifecycle. Yes, it is only lifecycle costing that is giving us the comfort of understanding the cost behavior of the product from the initial stage to the end stage of the product's life. So this one is actually correct. So the answer should be A. Which of the following statements is or are true regarding life cycle costing? Number 1, life cycle costing takes into account all costs incurred in product life cycle, with exception of sunk costs incurred on research and development. Okay, guys, we know that even initial costs like research and development are part of the cost of the product. Then how come this statement is saying that those costs have to be ignored? Do not be hoodwinked by this term, sunk costs. In life cycle costing, those costs, the pre-launch phase cost, are also going to be considered. So this one is not correct. Those costs have to be considered. They are very, very important. So anything in an examination, anything with a 1 is incorrect. This one is incorrect. This one is incorrect. So we are left with, let us move to 2. Life cycle costing ensures a profit is generated over the life of the product. That's the idea of life cycle costing. We want profitability throughout the life of the product. It might be impossible in year 1, in the initial stages, but the following stages should justify profitability, should give rise to profitability throughout the life of the product. So is correct. Life cycle costing is most useful for products with an even weighting of costs over their life. Now, we talked of spreading out costs, but doesn't mean that should be the costs themselves should have that behavior of having the even or spread out characteristic. No, the cost might not be as even, but the idea is that those costs will be spread. Technically, will be spread because remember, when we are saying we are adding up the cost incurred in year 1, year 2, year 3, and divided by the total number of units produced over those periods, we are spreading out the costs. So it doesn't necessarily mean that the costs themselves should have a behavior of simply maintaining a certain level. No, that's not it. The cost might be having 1 million costs in year 1, in stage 1, and then 300,000 in stage 2, and something like that. But regardless of the fact that they are of different levels or sizes, they would be spread out when we calculate the cost per unit. So this one is incorrect. So you can see that the answer should be B. This is the last question, ladies and gentlemen, and I hope You might pause the video and start the question on your own. Okay, let us do it together. Company B is about to start developing a new product for launch in its existing market. They have forecast sales of 20,000 units, and the marketing department suggests a selling price of $43 per unit. The company seeks to make a markup of 40% product cost. It is estimated that the lifetime cost of the product will be as follows. So design and development, that's 43,000, which is one of the costs we need to incur when we calculate the life cycle cost per unit. The manufacturing cost per unit, that's $15. So manufacturing cost in total, that will be multiplied by 20,000. This should give us how much? Let me use my phone here. I want to, disturb the screen. Okay, that's 15 multiplied by 20,000 plus 300,000. Then plant decommissioning cost 30,000. So if we add 43,000 plus 300,000 plus 30,000, that should be 373,000, right? 373,000 divided by 20,000. This should give us $18.65 as, okay, so we are saying 43,000 for those who are not quick enough, plus 300,000 plus 30,000. This gives us 373,000 divided by the units produced is 20,000. This should give us $18.65 per unit. So, ladies and gentlemen, this is the easiest topic you can meet in this examination. Now that you are prepared, please give me a like to this video. Continue to share the videos to your peers and friends, even your relatives and your kids, so that they pass this ACCA paper with easy. Until next time, please continue to feel excited.